Hello, iBond fans. This is the video many of you have been waiting for. So, as some of you already know, the January inflation numbers were released just a few days ago, with a year-over-year increase from 2022 of 6.4%, higher than expected, and a month-over-month increase from December of 0.8%. With that in mind, here's what I'll be covering in today's video. How things are looking on my iBond variable rate tracking sheet, and what my current prediction is for May. How much you could earn on your iBonds depending on what the May 2023 iBond rate might be. And why I'll make my iBond purchasing decision between April 12th and April 23rd. And for those of you who are interested in more details from this latest inflation report, including the fact that the CPI-U weights will now be updated annually versus every 2 years, I've included the Bureau of Labor Statistics link to this latest inflation report in the description below. Here's what we have so far on our May 2023 iBond variable rate tracking sheet. CPI-U from the end of September 2022 to the end of December 2022 was essentially flat. Well, flat it did not stay, with January 2023 CPI-U coming in at 299.170. This brings us to a 4-month CPI-U percentage change of 0.8%. So, my crystal ball is a bit fuzzy. I mean, who are we kidding? I don't have a crystal ball. I have lots of numbers and analysis, but no crystal ball. And unfortunately, I don't know any real person who does either. But I'm going to give you my best May 2023 iBond prediction anyway, because so many of you keep asking. If we assume that CPI-U in February 2023 and March 2023 grow at a similar monthly pace as it did between December 2022 and January 2023, with no massive swings in rent, oil, or who knows what else, this is where things could end up for the annualized May 2023 iBond rate, between 4 and 5%. The lower end assumes that the Fed's rate hikes continue to work further into the system, and the higher end assumes that February and March numbers will increase more on a monthly basis than January's did over last December. Because if we take a look at this table here, from 2022 all the way back to 1998, when the iBond was first issued, January's monthly increase in inflation over December was less than the average monthly increase in February and March, about 2/3 of the time. Having said that, even if things don't follow a similar pattern this time around, let us not forget about the fixed rate. If the Treasury does tack on a fixed rate on May 1st, which is my assumption as I talked about in length in this video here, that could also get us closer to the predicted annualized May 2023 iBond rate of 5%, or perhaps even a bit higher. Now, I know there are quite different viewpoints on the direction inflation is heading in the community. What do you think of this number and where inflation is headed? Drop a comment below and let's see if we can get some constructive conversations going. So, given that no one really knows where the May 2023 iBond rate will actually be at this point in time, I thought it would be interesting to show you a few scenarios for how much you could earn on your iBonds, depending on when you bought them and where things might end up on May 1st at the next iBond rate reset date. Here's the order I'm going to go in for this section. First, I'll be speaking to those of you who bought your iBonds at the annualized iBond rate of 7.12%. Then, to those of you who bought your iBonds at 9.62%. And last but not least, to those of you who bought or are planning on buying at the current 6.89%. And the assumption for each of these illustrations is that your initial investment amount was $1,000. This actual section here shows the annualized iBond rates that have already been announced for the first 6-month holding period, the second 6-month holding period, and the third 6-month holding period. Here are the annualized iBond rates divided by 2 to adjust for the 6-month period during which the stated annualized iBond rate actually applies. And here's your ending balance at the end of each of these 6-month holding periods based on these rates. This predicted section shows what your ending I-bond balance could be under various scenarios in the fourth 6-month holding period, as well as the annualized return over the 2-year holding period, depending on where the May 2023 I-bond rate might end up. Do note that these ending I-bond balances are calculated for I-bond investors who are in this for the long haul and exclude the early withdrawal penalty of the last 3 months' interest during the first 5-year holding period. So, if you're planning on redeeming your I-bonds before that point, make sure to factor that early withdrawal penalty into your own calculations. And because I know the question will come up, if you redeem your I-bonds 3 months into this scenario of a 0% 6-month period, you essentially don't pay any early withdrawal penalty because you would have earned 0% interest for the last 3 months. This actual section here shows the annualized I-bond rates that have already been announced for the first 6-month holding period and the second 6-month holding period. Here are the annualized I-bond rates divided by 2 to adjust for the 6-month period during which the stated annualized I-bond rate actually applies. And here's your ending balance at the end of each of these 6-month holding periods based on these rates. This predicted section shows what your ending I-bond balance could be under various scenarios in the third 6-month holding period, as well as the annualized return over the 18-month holding period, depending on where the May 2023 I-bond rate might end up. As in the previous section, do keep these 2 notes here in mind regarding the early withdrawal penalty as it relates to these numbers. As in the previous sections, this actual section here shows the annualized I-bond rate that has already been announced for the first 6-month holding period. Keep in mind that all the numbers in these 2 rows, in fact, already have the 0.40% I-bond fixed rate incorporated into them. So here's the actual annualized I-bond rate divided by 2 to adjust for the 6-month period during which the stated annualized I-bond rate actually applies. And here's your ending balance at the end of this 6-month holding period based on this rate. This predicted section shows what your ending I-bond balance could be under various scenarios in the second 6-month holding period, as well as the annualized return over the 12-month holding period, depending on where the May 2023 I-bond rate might end up. And as I mentioned before, these I-bond rates here already include the 0.40% I-bond fixed rate, meaning that if we look at this first predicted scenario, the I-bond variable rate is actually 0%. And also, as mentioned in the earlier sections, do keep these 2 notes here in mind regarding the early withdrawal penalty as it relates to these numbers. Now, there is one additional thing to be aware of about the numbers I just showed you. And that's that my analysis assumes normal compounding of interest every 6 months. Due to the number of different scenarios we had to run, I did not incorporate the complexity of rounding based on $25 purchase increments that Treasury Direct uses in this I-bond interest formula that we unveiled for all of you in this video last year. Meaning that if you created your own spreadsheet based on the formula that we deciphered in that video, there may be some instances when your numbers and my numbers may be off by $1 or so depending on the principal value that you use. And for those of you who are thinking, what's Jennifer talking about? I've linked this I-bond interest formula video in the description below if you're interested. So now that you have these numbers, you can always come back to this video when the next round of inflation numbers comes in to see which predictive scenario might be the most applicable for your situation. Now, let's move on to how I settled on the 11-day window between April 12th and April 23rd to make my I-bond purchasing decision. Here are the 3 primary reasons why. 1. April 12th is when I'll know what the May 2023 I-bond variable rate will be. Because according to the Bureau of Labor Statistics calendar, that's when the March CPI-U numbers will be released, meaning That's when I can properly calculate the May 2023 I-bond variable rate, as well as factor in my expectations for the fixed rate. And April 23rd, that's so that I have a good buffer, 5 business days to be precise, before month end, in case Treasury Direct crashes or my order doesn't get processed the next business day, like it's supposed to, for whatever reason. 2, there are enough decent yielding alternatives where I can park my money between now and April, when I'll be making my I-bond purchasing decision. We're in a very different market environment now than we were this time last year, when T-bills, CDs, and high-yield savings accounts were paying basically next to nothing. The 26-week T-bill crossed 5% for the first time in a long time at the February 13th auction, with the 13-week not far behind. CDs of different maturities are now going out at 5% APY. We've already talked about 2 on this channel in the past 2 weeks. And there are quite a number of high-yield savings accounts paying in the high 3 and some even in the 4% range. So while we wait until April 12th to find out what the May 2023 I-bond variable rate is, I'll simply keep laddering into short-term T-bills. 3, the outlook for inflation is uncertain at this point. The Fed has committed to keep raising rates this year. And my expectation at this point is that they will continue to do so through at least about the first half of the year, which means that inflation should, in theory, be edging downwards. Given these 3 factors, plus the amount of I-bonds we have in our portfolio, the number of years we have until retirement, during which time we could be stashing our cash into higher yielding investments, and the fact that our I-bond money is basically illiquid during the initial 12-month holding period, waiting until mid-April is what works best for us this year. Now, if you're a super saver who falls into any of these categories though, you're in your 20s, 30s, or 40s with quite a few working years ahead of you, like us, or you're older and closer to or in retirement, or you're someone who simply adds I-bonds every year to your portfolio for inflation protection, then be sure to check out this video here on whether tips, I-bonds, or some combination of both might be something you may want to consider. And do drop a comment below and let me and the community know when and or if you're planning on buying more I-bonds in 2023. And if not, where are you putting your money instead? Curious minds want to know. All right, Super Saver, as always, I hope you enjoyed this video and learned something new. And if you did, don't forget to share it with those you care about. And of course, hit that thumbs up and see you again very soon with another brand new wealth building video.